University of Houston, personal finance. We are going live. It is insurance day. So let me fire up. We're live on Facebook and YouTube, but we're not yet open in Zoom Me. So let's go ahead and get Zoom open. And let me find Zoom. Zoom. Welcome aboard if you're on Facebook or YouTube. Give me just a minute to find Zoom. I've got too much open on my computer. Okay, here we go. Start. Admit. Welcome, Zoom folks. If you would, let me know you can hear me. Jose, can you hear me, man? Awesome. Okay, cool. Well, thank you guys. I know you got short notice that I was going to be not in class today. So, for those of you who were planning on seeing my smiley face in the flesh, thank you for your uh, flexibility. So, I'm recording, we're live on Facebook and YouTube. Today, we're going to talk about insurance. And it looks like I've got. Hey, Jose, what do you see on your screen right now? Okay. Do you see the anything from Zoom, or do you see insurance? Do you see this word insurance? Okay, cool. I'm trying to make sure I see or I know what you're seeing, so I think we're good to go. So this is a PDF I'm going to use for today's chat about insurance. So thanks, Jose. I'm assuming everybody else can hear me. I'm still admitting folks. Hey, is anybody out there on Zoom sitting in the classroom? If you are, let me know. You get extra points for that. Not really. They're imaginary points, but you do get extra points for that. If you're sitting in the classroom, speak up. Let me know. That would be. By the way, the 10 a.m. class I have two classes, 10 a.m. and 11:30. The 10 a.m. class usually has about 3 or 4 people in it. So if those 3 or 4 people are on this call, on the Zoom call or on Facebook, YouTube, I'm just curious if you're there. I wanted to say hello, a special thank you. All right. So we have another minute to get started. Like I said, we're going to talk about insurance. I'm going to do an overview of insurance today. Try to hit some high points that I think will help you be a better consumer of insurance. Insurance is a big part of your budget. So if you look at a regular budget and you look at the categories inside of that budget, one of those categories would be insurance. And so there's everything from health insurance to life insurance to car insurance to home insurance, business insurance, something we call personal liability umbrella insurance, long-term care insurance, disability insurance. What else? There's a lot of types of insurance, and there's no way that I can cover all of those in any detail in 1 week. We could do a whole semester and still just really cover the surface of insurance. So we're not going to go too deep. We're going to go kind of wide and thin. But I do want to try to give you guys some insights and some overview of insurance so that you can at least begin to think about how insurance works and how you can use it to your benefit so that that big budget category called insurance can be as lean and mean and efficient as possible, because that's really the key when you're buying anything, like we talked about last week in bargaining and negotiating. When you buy insurance, you will be constantly bargaining and negotiating with yourself around the premium, which is how much you pay for insurance. So I'm going to grab my iPad. See, I've got the same thing on my iPad that you have on your screen. So I'm going to get myself set up. It's about time. I'm admitting the last student. It's about 10:06, so we're ready to roll. Before I get started, though, I want to give you guys an opportunity to ask any questions you might have about last week's assignment. Hopefully, you did some thinking and learning around negotiation and bargaining. Like I said last week, I think bargaining and negotiating, for many of us, it's like a sport, something we look forward to. We're not afraid of. We actually enjoy it. But then there are a lot of folks like my wife, Connie, who see it as something not that fun, a little bit awkward, something they don't like to do, like she doesn't like to do. She leaves it up to me, which is fine. Regardless, either way, my point last week was that there is a big, I think, a pretty significant percentage of benefit for people who bargain and negotiate and people who don't. So if you're one of those people that thinks it's really not for you, I just want to encourage you to learn a few basic skills related to bargaining and negotiating so that you can at least take advantage of those opportunities where it takes really very little effort if you have a little bit of skill. And so last week, your assignment was to develop some of those skills or at least put them on your radar. So I shared my top 7 at the end of the class at 11:30. That's in the Zoom meeting from last week. It wasn't all that profound. There are 7 basic tips about negotiating that I found helpful, and I thought, they made my top 7. But in your assignments, you're giving me your top 7, and I've been enjoying reading those. So any questions about last week's assignment before we jump into insurance? I'm looking at the chat and I don't see any questions. Thank you guys for punching in. I'm not really keeping roll this semester. That was part of our deal at the beginning of the class. Hey, Alexandro, I see you're from the 11:30 class. Thank you for posting that. And anyone who is from the 11:30 class, if you wouldn't mind just posting that. I will be available if you're not. I will be available at 11:30. We'll have a short Zoom meeting to go over the homework and answer any questions. But I probably will refer the 11:30 class to listen to this class on Zoom, on YouTube, Facebook. So let's get started. Before I jump into insurance, I want to just point out that this week's assignment, I'm going to try to keep looking at the chat in case you have questions, but this week's assignment in insurance will be to get a car insurance quote. So it's not difficult to do that. I will encourage you to, and it's in the homework assignment, I'll post that later today. But when you go to get a quote for your car insurance, the best and easiest way to do that is to go to your own insurance company. So if you're insured with State Farm, I was a State Farm agent for many years. If you're insured with State Farm, you want to pick up the phone and call your agent at State Farm and just say, hey, I need to get a quote on my car insurance. It doesn't mean you're going to change anything or do anything. It's just you need to get a quote so you can compare the coverages that we're going to talk about today. The easiest, I think the most effective way to understand insurance, whether it's car insurance or home insurance or life insurance, is to get a quote. And so that's certainly true in car insurance. And car insurance is probably the most common insurance we deal with. It's certainly one of the types of insurance that we need to understand. You need to understand car insurance because over your lifetime, you're going to use your car insurance. You're going to actually file claims. It's almost inevitable, like absolutely certain that you will file some type of claim on your car insurance policy. So I want to help you understand those coverages. But in the meantime, the main thing I want to do is I want to help you learn how to think about insurance, help you kind of get your feet in the pool in terms of learning about how insurance works. That's what I want to do today, is try to help you become a more informed consumer of insurance. So it's, again, I can't go deep into all the topics that'll be on the page today, but I can at least cover some things that I think will help you be interested in learning more about insurance and having a better approach to learning about insurance, because you're going to need to learn about insurance throughout your life. So here we go. I want you to know, by the way, these notes that I'm looking at, they have a table of contents, and I posted these in Money Study Group. So you'll have the document that I'm looking at now. It's like 15 pages long. And I wanted you to know, I'm pretty proud of this, that if you wanted to go to uh, a link, the table of contents has links. So just so you know, that's in Money Study Group. You don't really need to take notes today. You're welcome to if you'd like, but you don't have to. So I am going to jump into the notes and just give you a quick preview of what I'm going to try to talk about today. And again, if you have questions, if you have any questions about any kind of insurance, get ready to post those questions in the chat so that I can answer them specifically. And I'll do my best to answer any questions you have today about insurance. Insurance is, I think I told you last week, it is one of the areas that unfortunately I would be considered an expert in. I have a lot of letters after my name, and almost all of those letters relate to the insurance business, insurance qualifications. I was a State Farm agent for many years. And so I know more about insurance than I really care to know about insurance. And I had a great career as a claims adjuster with State Farm, and that's where most of my stories come from. And so I find insurance fascinating. I really do. Doesn't mean that it's something, so I teach insurance at Rice University. I haven't taught since COVID hit, but I teach the insurance component, and that Rice has a CFP, Certified Financial Planner program, and I'm fortunate enough to be an instructor on their roster to teach insurance. It is one of the most painful experiences of my life. I do not enjoy teaching that class. I do it when they need me, and I'm happy to do it, but it is like so much minutia. And I would prefer to teach what I'm going to teach today, because I can teach you in stories and help you understand the most common things you want to know about insurance, which in my opinion is way more interesting, way more practical and useful than teaching you all of the minutia that you have to know in order to pass the test, to get those three little letters after your name, like I have after my name, CFP, Certified Financial Planner. Those little letters are very meaningful to those of us who are in the business. So I'm just going to write those, see if I can write those for fun. Awesome. I'm using my, looks like I got disconnected. Am I disconnected? Hey, Jose, do you see my face or no? You know why? I don't either. But I'm going to try to get reconnected. Um, I think it's because I probably got a phone call, but I don't really know. Well, give me a minute. Sorry about that. I hate it when that happens. Okay, give me just a minute. I'm sorry. Hmm. I guess you can still hear me, right, Jose? Cool. Give me a second. You can see me now, right? See green behind me? Oh, good. Okay. All right. Let's see if we can get back in the game here. Oh, I got to get. Yeah, let's see. Hmm. You know, technology is sometimes a pain in the butt, but it is also what allows us to be here and there and everywhere. So, okay, let's get going. Hopefully, I won't get disconnected again. I'm sorry about that. So, insurance, back to insurance. We're going to cover today. What I want to cover is I want to go over three main types of insurance so you understand how they work. First is I'm going to talk a little bit about your homeowner's insurance. And when I say homeowner's insurance, I would be talking about home and renters. So we'll talk a little bit about homeowners insurance. We'll talk about what's on the declarations page, otherwise known as a deck page, which is a very important piece of your homeowner's puzzle. And then we'll talk about car insurance, which is where we'll spend most of the time. But somewhere in the middle of that, I'm going to talk about personal liability umbrella policy. So, again, all this is in your notes, and you don't really need to you don't need to take notes. I think if you just listen and try to follow along, I'm going to tell you some stories so you understand how the coverages work. I think that's probably the best way to go about this. So, a couple of things I wanted to highlight first is, and these are in your notes, some interesting statistics about insurance. In 2016, I don't know why we have statistics from 2016, but we do. 37,461 people died in car crashes in 2016. And there were 1.3 million fires reported in the US. Can you guess where most of those fires were reported? Anybody? You want to guess? Yes. Ashley? At home, yeah, but so, yeah, I'd say California. Uh, California is notorious for wildfires. So 1.3 million fires in 2016. I have no doubt that probably half of them were in California. I don't know that, but definitely someplace you want to have fire insurance. They caused 3,390 deaths, so that's kind of sad. $11 billion in property damage. Again, that was 2016. Um, so here's some more statistics. There were 3,755 triplets born in 2016. 322,198 robberies in the United States. Can anybody tell me if that number went up or down during and following the COVID pandemic? Robberies up or down since COVID? Yeah, I think it went up a lot. Um, so there were 27 lightning fatalities in the United States in 2016. Can you imagine getting hit by lightning? It's it's not something I would want to do. Let's see. I didn't know this, but 54 authenticated, unprovoked shark attacks across the United States. Last time I was in Hawaii, we took a trip to the North Shore, and there were some people surfing, and there was a girl out there, and we just watched for a little while. And that day it was our last day in Hawaii. We flew home and found out on the news that this girl had her arm bitten off, and it was on North Shore. So she was probably one of the surfers that we were watching. Okay, let's talk about three ways to manage risk, because when we talk about insurance, Insurance is risk management. And I may have mentioned this last week, but I want to mention it again. When you think about personal finance, especially from the perspective of a professional, a certified financial planner, the training that we go through to become a certified financial planner includes 7 major categories, or 7 what I call essential elements of financial planning. And it's one of the reasons that we're even including insurance in this course, because one of the 7 essential elements of financial planning is risk management, and that's insurance. So everything we talk about today in terms of insurance is risk management. And there are 3 ways to manage risk, and that's what I wanted to point out. And these 3 ways of managing risk, the first is to avoid it. And I say don't ride a motorcycle. So maybe you remember, I drive a Goldwing motorcycle. Today it's raining, it's ugly outside, so I'm not driving my Goldwing today. But one way to manage risk is to avoid it. So think about the things that you do in your life that may involve risk. Risk to your body, risk to your money, risk to your vehicle, risk to your home, all kinds of things that we do that involve risk. And so the first and really the best way to begin to have a risk management program is to look for the things in your life that you can just avoid. So for example, when I was in college, I played basketball. I didn't play that very good. I was a manager on the basketball team, so I got to go on all the trips, with the team. It was pretty awesome. We won nationals 2 years out of the 4 years that I was the manager, not because of me, but it was a great little job in college. I got paid to go hang out with the athletes. I got to live on the athletic dorm, but I wasn't an athlete. I mean, I was not really an athlete at all, but I did love to play basketball because it was fun. And so I played basketball until I hurt myself multiple times. So that's one of the things that, as I graduated from college and started working, I had to really think about the pain that came every time I twisted my ankle or hurt myself in some other way playing basketball. So that's one way of managing risk is don't play basketball. Don't drive a motorcycle. Don't don't buy a fast car and drive super fast. Don't uh, My son has his airplane license. My dad did too. But that's an area of risk. I mean, the reason you pay a lot more for your life insurance if you're a pilot is because statistically, if you're flying a small plane, your chances of dying are greater than mine. I don't have a pilot's license. So avoiding risk is one of 3 ways to manage risk is avoid it. Number 2 is minimize risk, which is just, I say, drive a tank slowly. So maybe you don't want to give up. I don't want to give up my Goldwing. I don't. I'm going to keep driving it, hopefully till the day I can't drive it anymore. Uh, but one of the things I do to manage the risk, to minimize the risk on that motorcycle, is to take the express lane. I think I mentioned that before, but uh, so where I live in Friendswood, there's an express lane that goes into Houston, and it actually has an exit right there on main campus where my office is and where class is. And so if it's not raining, or it's not 120 degrees, or it's not 20 degrees, as long as it's reasonable and not raining, I will drive my motorcycle to work because I get to take that express lane. So I know that it's pretty risky to drive a motorcycle in Houston, but for me, managing risk, meaning minimizing risk, is driving my motorcycle on the express lane where there's just one lane, and it goes into Houston in the morning and it comes to my house in the afternoon. So I'm not passing vehicles, they're not passing me, and I'm minimizing risk by doing that. And it's free if you're on a motorcycle. So I love it. I love driving a motorcycle. And so I minimize risk doing that. Another way, and the final way, the third way, the one that we're going to talk about for the rest of today, is to transfer risk. That's what insurance is. It's transferring risk. So you pay money, which is called a premium, so that you transfer the risk to the insurance company. And that's what we're going to talk about. And again, it's pretty expensive. There are a lot of people out there who sell insurance. It's one of the biggest categories of employment in the United States. And it's a good way to make a living. So if any of you are thinking about or considering working in the insurance business, I hope one day we can have a conversation. I can teach you a lot about insurance. I've made a lot of money in my life in insurance, both in claims. I was a claims adjuster for State Farm before I became an agent for State Farm. And even to this day, I have an adjuster's license. And I'm also licensed as a public adjuster, which is a whole nother thing, which I did during Hurricane Harvey because I had a lot of friends who were really getting, I don't want to say a bad word here, but they were getting taken advantage of by their insurance company. So they needed someone who understood insurance to help fight for them against the insurance company to make sure they got paid on their claim. So adjusting is the business end of insurance. If you have an insurance policy, one day you're going to file a claim, and that claim gets handled by a claims adjuster. It doesn't really matter what type of insurance you're talking about. Every type of insurance has a claim, and every type of insurance involves a claims adjuster. And I've adjusted claims across the country, and pretty much, well, I haven't adjusted life insurance claims or disability claims, but property and casualty, those types of claims of all kinds, I've been involved in. All right. So again, insurance is pretty common these days. You're even asked if you want to buy insurance on pretty much anything you buy. Like if you buy an Apple product, Apple Care is insurance. You're transferring the risk to Apple. So let's see. We've got some factoids. I'll let you read those on your own. They're kind of interesting. But one of the things I wanted to point out is I want to mention Lloyd's of London in a minute. But here are some things that you would be insuring against. So some ways that you can transfer. And the question is, are you covered? You're probably not covered so much now, but as you get out of college and into your career, you're going to want to review what types of coverages you really need. And so this list is just a quick list of things that you would want to insure against. These are areas of risk that if you were my client and I was your financial planner, your financial advisor, these are the things we would review in one of our meetings. I call it the gap analysis. One of the gap analysis areas of focus is risk management. So, if you have a financial plan, if you're a person who has a family, premature death is a big risk. And obviously you transfer that risk to an insurance company through the form of life insurance. And so life insurance is a type of insurance, but it's also a big type of risk. And again, it's a risk if you have people who depend on you. If you don't have anyone depending on you, then that risk is not really relevant to you so much. But that's a big risk. Another big risk is disability. So disability is insurance that replaces your income. In the event that you get sick or injured and you can't work, disability insurance is what replaces your income. And so a couple of statistics you might want to keep in mind as you think about these examples of risk. I would say that in terms of death and dying, I don't know if any of you have ever seen the first quote in my book, Make Your Money Count. I don't have a copy of it handy, but I would show it to you, and I may post it in your somewhere. But it's my favorite quote in the book. It's the very first quote of the book. It's from Ricky Bobby of Talladega Nights. I should have put it here in the notes, but Ricky Bobby says, 98% of us will die at some point in our life. So he says a little planning goes a long way. So that's just a statistic to keep in mind. According to Ricky Bobby in Talladega Nights, 98% of us will die at some point in our life. So that's one statistic that's kind of supposed to make you smile. Disability, the statistic for disability is that 1 out of 5 of us within 3 years will get sick or hurt and not be able to work for 6 months or longer. Now, I don't know how accurate that statistic is, but that's the industry statistic. 1 in 5 people, that's what an insurance agent would tell you while they're trying to sell you disability insurance. And I'm not trying to sell you disability insurance, but if I was your financial planner and you were in your income earning years, and especially if you had a family depending on you, I would be saying that to be smart, to have a good, effective financial plan, when I do your gap analysis, one of the gaps I'm likely to find, which I find in so many plans, is disability protection. So most of the time that comes from your employer, but if you happen to be self-employed like I am and you need protection. Now I'm 59 years old, so let me ask you, you don't have to answer unless you want to, but do you think that I need disability coverage, disability protection? Would it be worth it for me to spend, uh, let's say that it cost me $8,000 a year to have disability protection so that I could recover $60,000 a year for 2 years if I got sick or hurt and I couldn't work? Would it be worth $8,000 for me to replace 60% of my $100,000 a year income? What do you think? It, it, at this point, I don't need, like, it wouldn't be that big of an emergency for me if I lost my income. I could live on the money that I have saved and invested. It would be nice to have that income replaced, but I'm not going to spend $8,000 knowing the statistic is 1 in 5. But if I were 27 years old or 35 years old and my family was just, we were living paycheck to paycheck, or we really needed my income, if I was your financial advisor, your financial planner in that scenario, then my advice would be very different. You definitely need to put the money aside in your budget to pay for that type of insurance. For one thing, depending on what you do for a living, disability insurance, if you work in an office, isn't going to be that expensive. But when I started as a State Farm agent, I worked in a town called Ridgeway, Pennsylvania. And in Ridgeway, probably a quarter of my clients, a good number of my clients, worked in the woods. Ridgeway was right in the Allegheny National Forest, right on the edge of the Allegheny National Forest. One of the biggest industries that supported the county was the lumber industry. People cut down trees and made lumber out of it, and people had to do that. And many of my clients did that for a living. So what do you think the cost for disability insurance would be if you were in the field using a chainsaw versus someone who went to work in an office? Disability insurance is based on the type of occupation you're in. So if you're in a risky occupation, you pay more for it. If you're in an office environment, you pay less. But it's a big risk, and it's one that you should think about once you begin. If you start a family, and if your family is depending on your income, it's an important piece of your financial plan. Next is health. Health issues obviously are a big. I just paid my health insurance premium. I just got an email telling me that I paid my health insurance premium. Once I turn 65, I'll qualify for Medicare, which will be a better deal than typically you get from private insurance. And again, if you're self-employed, the cost of insurance can be pretty high. If you work for an employer who makes that part of your benefits package, then that's a really good benefit. But it's expensive. It's one of the biggest risks you're going to face in your life. So there's lots of different types of health insurance. I'll give you one example of health insurance you may not have thought about being health insurance. It's called long-term care insurance. And statistically, 1 in 2 people will require long-term care. 1 in 2 people. So maybe you've got a grandparent, an aunt, uncle, someone you know who is in a nursing home. That is long-term care, or they're being cared for in a home provided by family member. That's still long-term care. So 1 in 2 people will require that kind of care. And you can buy long-term care insurance to transfer that risk to the insurance company. It's pretty expensive. I have some for myself and my wife because it's just something that my wife didn't want to buy it, but something that I believed would be helpful. I did not want my kids changing my diaper. That's the bottom line. Health insurance that provides coverage for long-term care means you get to go select your place to be cared for in the event that you're, needing full-time care. And it's not something fun to think about, but in terms of cost, the cost is extraordinary. And so as a financial planner, it's something that again, when we do the gap analysis, it's one of the things I find pretty regularly that we have a gap here. We need to talk about it. We need to make sure that the plan deals with that exposure. And then liability issues, these are things like, say, you like to go hunting. Maybe you're a golfer. Maybe you're like me, you're a terrible golfer, but you love to swing those clubs and hit those little balls, and you never know where they're going to go. Well, liability is an exposure. So if I hit a golf ball and it hits you in the eye and knocks out your eye, and let's say that you're a brain surgeon, I just created an incredibly big claim for myself because it's my fault. I hit the golf ball and I hit it into your eye. That's liability. Or maybe you like to drive fast and you have a fast car and you get in an accident and it's your fault. That's liability. Liability is a big exposure, and that's why you have liability coverage on your auto policy, on your home policy, and that's why we have this thing called a PLUP, a PLUP, personal liability umbrella policy, which we'll talk about in a minute. And then property damage. We've already talked about fires, and if you get in an accident in your car and you destroy your car, that's property damage. So those are types of risks. And here's some more. I already talked about long-term care, but that's another risk. It's just on another page. And running out of money during retirement, it's a big risk. It's why people hire financial planners to help make sure that they have enough money. And that's something you're going to work on throughout the rest of the semester, is understanding how do you project whether or not you'll have enough money in retirement. You do that with a financial plan, and you're going to be able to do that as well. Here's some types of insurance. We won't go over all of them, but I've mentioned most of them already. So health insurance, life insurance, disability insurance, long-term care insurance. I don't know if you knew this, but annuities are really an insurance product. Property and liability insurance, that's auto, car insurance, home insurance, and then there's that word again, the PLUP, the personal liability umbrella policy is what it's called. And then there's credit protection. That means basically when you get a loan, if you get a loan for your mortgage or a loan for your car, the person who's helping you facilitate that loan will probably ask if you want to buy insurance, because typically they get paid a little commission, a little bonus if you say yes. It's like a little policy that covers the loan. It's called credit protection, very common. And again, if you don't have enough life insurance, the credit protection is not a bad idea, depending on the cost. And again, everything related to insurance, it's about being smart with your insurance dollars. So let's talk about credit protection for a minute in the context of life insurance, just to give you an idea. of how you would go about life insurance. So this is kind of a little lesson inside the lesson on life insurance. How do you get the best bang for the buck in life insurance? First of all, if you're buying life insurance, it's a lot cheaper if you buy it while you're young and healthy. If you wait until you're older and you're taking 3 or 4 prescription medicines, you probably won't even, you'll pay more, a lot more, just because you're older. And depending on what your illness is, you may not even qualify for life insurance. So I always tell folks, even if you're young, even if you don't have a family, but you think you will someday, while you're young and healthy, it might be a good idea to do a little research and find out what would it cost to buy an insurance policy that would give you cheap, long-term protection. It's called term life insurance. And that's what I generally recommend for folks who are young. And term life insurance is cheap, and you can get a long term, meaning how long is it in place, for like 20 or 30 years. And you can get a lot of it, like $1 million or $250,000 or more, for pretty reasonable amount of money. Now, it's like buying popcorn at the theater. When you buy life insurance, it's like buying popcorn at the theater. If you buy a small popcorn versus a medium popcorn versus a large popcorn at the movie theaters, how much price difference is there between a small and a medium, or a medium and a large popcorn? Is there a big difference between a small? Maybe you don't know, but trust me, I know about large popcorns. My wife and I will share a large popcorn because it's a whole lot cheaper than buying 2 small popcorns. It's not very much more expensive at all, and sometimes that's how life insurance works. So the reason I bring that up is because credit protection, not everybody, but people ask me quite often about, should I buy this life insurance on this loan? And my answer is, it depends. If you have a good policy in place and you have sufficient coverage, you probably don't need that credit protection, because it's like buying a small popcorn. It's going to be more expensive, quite a bit more expensive than if you buy a regular term policy and you get it for the preferred rate, meaning you're in good condition, good health. You qualify for the preferred rate. You're going to get a good deal on your big life insurance policy. And so you don't need a bunch of little life insurance policies every time you get a loan. But if you don't have that policy in place, then it might make sense for you to get this credit insurance, this credit protection on every loan you get. Your home, your car, your second car, your boat, your motorcycle, whatever it is you're buying. If something happens to you, you're dead, somebody's going to pay that loan. So if you don't have life insurance, the credit protection is a good deal. Social Security is a type of insurance. I know a lot of people that try to not pay Social Security. Maybe they have the option. People in ministry, like if you're a pastor, you work for a church, you can say, I don't want to pay Social Security. I've seen that turn out terrible for people. So just think of, I know Social Security, it costs you money, but it is like insurance, okay? It replaces your income when you're old. Not much of your income, but some of it. And identity theft, there's insurance for that. I don't think it's a good value, but it is available. What I think, and we talked about this when you did your credit report, the best medicine from having your identity stolen is to do a credit report, review it. That's good insurance right there. It's free. You can do 3 of them a year. And change your passwords. But again, you can transfer the risk. So again, there's 3 ways to manage risk: avoid it, minimize it, and transfer it. And when it comes to identity theft, I'd say the last thing you should be doing is transferring it, because you're just going to pay money, and then you still have to go through the work. If you have your identity stolen, you still got to go through all the work, frustration of the results of that. And if you buy insurance, pretty much all it does is it helps you. It gives you some people that help do some of the tasks related to getting your identity back. But it's a terrible thing. I've never had my identity stolen, but I've experienced fraud in many, many ways. and you will too. So, okay, let's talk quickly about a personal umbrella policy just so that we can have a little context, because we're going to talk about home and car insurance here in a minute. But personal liability umbrella policy, it's a personal policy that you can buy. You probably don't need it today, but as you start to accumulate assets, a personal liability umbrella policy helps you protect your assets. It's a really pretty inexpensive policy. And the reason it's called an umbrella is because it goes over and above your liability protection on your home and your auto. Okay, so let's say that you have $1 million PLUP. That's what we call it in the business, a PLUP, personal liability umbrella policy, or PLUP. And if you've got a PLUP, typically it's $1 million, $2 million, maybe 3, maybe 5 million, depending on how wealthy you are, how many assets you need to protect. But it basically covers you for over and above whatever your home liability is or your car liability is. And we're going to jump into those, and I'm going to help you understand what your car liability is and how it works. I'll do that next. But I just wanted to mention the PLUP. It pays for anything that you do anywhere in the world that is your fault, or where there's damage, bodily injury or property damage as a result of your activities. So just keep that in mind. Something you do anywhere in the world that hurts somebody or breaks something, you're liable for it. And your umbrella policy will do two things. The umbrella policy does two things, just like any liability protection does two things. Number one, it defends you in court. So if you get sued, your liability protection is going to pay for your defense. It's going to pay the cost of going to court. That's very important because it's very expensive. So that's number one. And so if you've got an umbrella policy, they're going to pay to defend you in court. And believe it or not, if you have an umbrella policy, you're much more likely to get the A team than if you don't have an umbrella policy. And the reason for that is because, number two, the second thing that a liability policy does for you, in addition to paying for your defense, number two, is it pays any claims that are brought against you, any judgments that are brought against you, they're paid under that liability coverage. So the more coverage you have, like if you have $1 million umbrella policy, the more aggressive your defense attorney is going to be, meaning the insurance company is going to spend more money on your defense. And that coverage, providing the defense, little tidbit, this may be on the test, the quiz, the defense cost on an umbrella policy are unlimited. So the insurance company pays the defense attorney, and there's no limit on how much they'll pay. So now, the flip side of that is if you were at fault, and you were clearly at fault, and the damages clearly exceed your policy limits, even if it's $1 million, if that's the case, then your insurance company is just going to pay the claim, and then you're going to be on your own. So once the claim is paid, they're done with you. So that's one reason that a personal liability umbrella policy is very popular, because imagine if you just carry a small amount of liability on your home or car and you get in an accident that's your fault and you get sued, your insurance company can just pay that claim. If you have low limits, they're just going to write that check, and then you're on your own. So that's an important thing to think about, because we live in a litigious society, meaning people kind of like to sue each other to try to get money. And so the personal liability umbrella policy is something you're going to want to learn more about. So there is that. If you want to know more about it, there's plenty of notes. So I'm just going to now scan to, I told you we'd talk about Lloyd's of London. I'm going to leave it in your notes and let you guys look at this, but I think it's pretty interesting. Uh-oh. So I'm getting another message. Hold on just a second. So Lloyd's of London is an insurance company that will insure pretty much anything. And so some examples that are interesting. Bruce Springsteen insured his voice for $3.5 million. I don't know when. I don't know if that policy is still in effect. If you've ever heard of Betty Davis, there was a song when I was young called She's Got Betty Davis Eyes. That's how I learned that there was a person named Betty Davis who I didn't know who she was, but apparently that those are her eyes. And she was insured. She had a tiny waist apparently, and so she was insured against weight gain for $28,000. And Betty Grable, I don't have a picture of her, but she insured her legs. Apparently, she had some hot legs, and she insured them for $1 million. David Beckham, the famous soccer player, insured his legs for $100 million. So that's a pretty good amount of money. I have no idea what the premium was. Remember, the premium is the amount of money that you pay to transfer the risk. I don't know what the fine print was for David Beckham either. Like, imagine if he got bit by a tick and his leg swelled up, that he was out of work for a little while. That's just a crazy example. I don't know if that would have been covered, like a disability thing. Maybe it was only covered if he lost his legs or if he got some kind of, I have no idea, but it's interesting. Dolly Parton, anybody, my sister is a huge fan of Dolly Parton. And when I was a young kid, I noticed that Dolly Parton was different and attractive in ways that some young men probably noticed. She has reportedly insured her breasts for $3.8 million. Keith Richards, this is a dude from Rolling Stones, guitar player, insured his hands for some amount of money. I don't even know. 1.6 million. So there you go. All right. Moving right along. That was fun. Lloyd's of London. It's like the first type of insurance you learn about when you join the insurance business. You have to learn what it is, how it works. And so Lloyd's of London is one of the ways that they do that. Sorry about that. Okay, here we go. Homeowners insurance. We can do home or auto. We're going to try and rush through these. Not rush, but I want to give you some overview. First thing I want you to know about homeowners insurance is that you have a deck page. So we call it a deck page. It's a declarations page. And all property and casualty insurance policies have a deck page. So that's an insurance agent, by the way. That's not me. He's better looking than me, and that's not a very good picture. I think I grabbed that from Google. I have that picture. I have the premium one I should have used because I paid money for that stock photo. That dude, he's the guy I think of whenever I think of insurance agent. Smiley, good looking. He's always selling you something. And I know because I was an insurance agent for many years and I made a lot of money selling people stuff. Hopefully stuff they needed. That's what I tried to do. But here's the deal. The deck page is the page you need to know about in your homeowner's insurance. So if you're living with your folks and they have homeowners insurance, you might want to this week grab their deck page. Every time they get a renewal, they get a new deck page, declarations page. It has tons of information. And the next section in these notes really just deals with the deck page because it's such an important piece of the puzzle. So I'm not going to spend a lot of time. There is a picture of everything that's in a deck page. It's very low quality, so you can't see it on your screen. But it was a pretty good schematic for what's on your deck page. So contact information, policy numbers, coverage types, how much you're paying, your premium, those are all things that are on your deck page. The discounts that you qualify for, your mortgage company. So let me just tell you, if you have a mortgage, if you owe money on your home, you have to have the mortgage company listed and they'll be on your deck page. What that means is if you ever have a claim on your home, a fire, a hurricane, a tree falls down and breaks the roof, Any claim that you have on your home, when they cut the check, they call it a draft. When the insurance company sends out the draft, which is really a check, but it's a draft, it's different than a check. Oh, I won't get into that. But when they send it out, it's going to have the mortgage company's name on it, which means your mortgage company, that draft is going to have to go to the mortgage company, and someone at the mortgage company is going to sign off on that draft before you get the money to pay your contractor. So just something to know, and that's on the deck page. We talk about rental insurance for a minute. If you have a home, you need homeowners insurance. But if you rent an apartment, you can get the same basic coverages with a renter's insurance policy. So does anybody know the difference between a homeowner's policy and a renter's policy? I'm going to take a break, and I'm going to go over here and scan the chat and see if anyone is available to tell me what you think the difference is between a homeowner's policy and a renter's insurance policy. And if you're watching on Facebook or the YouTube, it's a good time for you to leave a comment and let me know you're watching on the YouTube or in Facebook, and I'll see your comment and I will know that you were watching and that you had a clue about the difference between a homeowner's policy and a renter's policy. There's one big difference. It's interesting that the policies actually are identical except for this one thing. I think they're identical. Same language, same coverages. Both of them have liability protection. Both of them cover property. Um, Anybody know the big distinction? I'm getting no comments. It tells me either you're watching Netflix or you lost me. Jose, are you still there? Come on, man, you know the difference between a renter's policy and a homeowner's policy. So it's pretty simple. If you rent versus own, when you buy an insurance policy, you don't need coverage for the house. Like if the house burns down and you're a renter, if I own the house and I'm renting it to you, I need to have insurance on the house. You don't. But you still need to have insurance on your bed and your microwave and your TV and your furniture and your clothes and your baseball cards. And if you're like me and you got a gun collection, whatever it is that you own, that's what you're going to have insurance to protect. And a renter's policy protects you against losing all your stuff in a fire, a hurricane, or a theft. So that's the difference. If you're a home owner, then your policy is going to actually pay to replace the house if it gets burnt in a fire, blown away in a hurricane. Then that's the difference between a renter's and a homeowner's policy. So now you know, Jose, and anyone else who's out there listening. I feel pretty lonely. Thanks, Jose, for letting me pick on you. I appreciate it. So that's the big difference. Again, liability claims, pretty important, and you get coverage for liability in a renter's policy and in a homeowner's policy. So I'm not going to break down everything that's on the deck page. I want to get to the homeowner's policy. Here's a quick summary of the coverages on a homeowner's policy. And again, these are in your notes. So you have coverage for the dwelling. That's not available in a renter's policy because you're renting. Personal property coverage, liability coverage. And there's this thing called medical payments coverage, which if I don't have time today, maybe I'll spend a minute next week. Medical payments coverage is a very important coverage on a homeowner's policy. But I want to jump into auto. So before I do that, let's talk about what makes your premium high or low. Whether we're talking about a homeowner's policy, a renter's policy, an auto policy, even a health insurance policy. What's the one thing that will affect your premium? One thing that will, I'm sorry, Jose? So age is a big one if you're talking about life insurance or you're talking about even car insurance. Age is a big one. But the one I'm looking for is your deductible. Do you know what a deductible is, Jose? Do you know how that works? So there it is. It's the amount you agree to pay out of pocket before your insurance steps in. And it's a pretty important piece of the insurance puzzle, your deductible. Whenever you buy a policy, for example, a homeowner's policy, you get to select what your deductible is. And if you have a high deductible, then your premium is going to be lower. But if you choose to have a lower deductible, your premium is going to be higher. So, why would you select a lower deductible as opposed to a higher deductible? I'll tell you a quick story. My friend Dave is he just bought a house. He bought his house just a few months ago, and he had a claim, and he was telling me about how expensive his deductible was. He had a tree fall on his house and damage his gutters, and his gutters have um, the screen thing that protects them from collecting debris. Dave paid his home, he paid about $850,000 for his house. And when he bought his insurance policy, his agent sold him a 2% deductible. So, what is a 2% deductible on a policy that's covered for $850,000? So, $850,000, 1% of that would be $8,500, right? So a 2% deductible means 2% of the coverage amount, the dwelling coverage amount. And Dave's house was, the insurance policy provides coverage for $850,000. So how much is his deductible if it's 2%? You can post your comment in Facebook or on the YouTube, or if you're in the Zoom meeting, 17,000, Kevin, you got it spot on. 2%, 17 grand. So Dave is like not very happy. He has a tree fall in his house. He has to make repairs. His contractor comes out and says, yeah, it's going to be about $8,000. And Dave's turning in a claim to his insurance company. And they're saying, great, thanks for turning in the claim. We will write an estimate. Give us a minute. Okay, here's your check. No check because the amount of damage is below the deductible. So why would Dave have a 2% deductible? Why would Dave have a 2% deductible? What's the benefit to have a 2% deductible on an $850,000 homeowner's policy? Anybody? Going once, going twice. Again, the deductible impacts the premium. The premium is the cost, how much you pay for insurance. So if you have a higher deductible, your premium will be lower, the cost will be lower. So Dave, when he bought the policy, his agent didn't really tell him about that. He just sold him the policy. Dave looked at the price. The price seemed good. So Dave said, okay. And then he filed a claim. And then, surprise, my deductible's high. And he knows that I know a little bit about insurance. So he comes to me and we have a conversation. And I'd say, next time, talk to me before you renew your policy. So at least I can help you understand what you have. So that's how the deductible works. Okay, let me jump into auto. Any questions? I'm going to find auto insurance here. Any questions, comments? Let me see if I can find the auto policy. Does anyone out there on Zoom at least, Harrison, you got it. Higher deductible means lower premium. Does anyone pay for your own car insurance? I'm going to ask about coverages. The first coverage I want to make sure you understand is liability. Man, there's a lot of notes here. You should really spend a few minutes and review these notes because there's some good notes here. Some helpful notes if you want to understand insurance. There's just way more than I can cover. But I want to talk about one of the coverages, and it's liability insurance. So it's Part A on your auto policy. It's called liability coverage. And you get, uh, there are these three numbers. Does anybody want to take a stab at what these three numbers are for? These limits, the 50, 100, 25? Anybody? And if you're watching on Facebook or the YouTube, feel free to leave a comment. What you're seeing on your screen right now it's a picture of a car on top of another car. Clearly there was an accident and somebody's at fault. So I want to make sure you understand how your liability coverage works if it happens to be you that's at fault. So when you do your auto quote this week, when you do your homework assignment, you're going to discover that you have three different numbers on your liability coverage. There's a 50, a 100, and a 25. Those three numbers, what do they mean? What do they mean? And when you get your quote, what do you think you need? 50, 100, 25? I think my policy is 250, 500, 100. But this one on the screen, 50, 100, 25. So let's talk about what those numbers mean on your auto policy. The first number, that 50, is bodily injury. So it's per person. I should have said bodily injury instead of bodily damage. That was a typo. Sorry about that. So bodily injury. Let me see if I can change that. Injury. So the first number, the 50,000, that number is per person bodily injury. So in this accident, we don't show any blood and guts, but there probably was. You could probably bet that the person that was sitting in that seat went to the hospital, and when they went to the hospital, they had some serious injuries, and those injuries resulted in a bill from the hospital, medical bills. And so that's what we're talking about here. We're talking about the liability that, let's assume it was you, and you were driving and you were going way too fast, and the accident was your fault, and this car not only got totaled, your car got totaled, their car got totaled. You know what totaled means, right? Totally destroyed, totaled, can't be fixed. But in addition to that, people went to the hospital. Maybe even somebody died. And so now your policy, you file your claim, and these are your coverages, 50, 150. So bodily injury, 50 grand is what your policy is going to pay for one injury or one death. $100,000 is what your policy is going to pay for the entire accident. So let's say that in that car, in this car right here, there wasn't just one person. Let's say there were 4 people in this car. They all went to the hospital. And let's just say, for the sake of your claim, that one of them died. How much will your policy pay for all of the people that went to the hospital? Let's say one person died and the other 3 people had $56,000 of medical bills each. So how much is your policy going to pay for any one person? $50,000. So 2 people will be covered for $50,000, or they may just divide it by 4. The adjuster will do that. But you see, the point here is, in this particular claim, no one person can receive more than $50,000. That's the limit. It's bodily injury per person. But the entire claim is only going to be able to recover $100,000. And since there were 4 people in this accident and it was your fault, what do you think happens with the remainder? So one person dies and 3 people have $56,000 of injuries combined altogether. So that's $168,000, if I did my math right. $168,000 in medical bills, plus a person died. So now you got funeral expenses, any medical bills that the person who died received before they died. So that's how much money. It's, let's say that it's more like $1 million, because the person who was in that car seat driving who died, maybe let's say they were a doctor or someone who had a pretty good income, and so they're 35 years old and they had a long career. The point is, the bodily injury, the medical bills, the whole claim is going to be pretty expensive. And your insurance company in this scenario, they're going to write a check to pay that family $100,000, and then you're going to get sued, and it'll be up to you to pay anything above that. So even though you don't have the money to pay that judgment against you, they'll do something called garnishing your wages for the rest of your life. So you will become kind of like an indentured servant to that claim, because you don't have enough coverage to pay for the damages that you caused. So I'm drawing a very ugly, bleak picture here so you can understand how these numbers work. And the 25, that number there is for property damage. So what's property damage? So that's your truck thing on top, and the vehicle on the bottom is property damage. It's not your vehicle. Property damage liability, that's their vehicle, and that is what the 25,000 is for. What you don't see in the picture, maybe a telephone pole, or maybe another vehicle that was damaged in the accident as well. All of that falls under this one number of $25,000. So now, if you're thinking about the personal liability umbrella policy, the beautiful thing about that is it goes above and beyond these coverages on the auto policy. So that's why it's so popular, and it's not very expensive. The one thing I'll warn you about is, if you ever want to buy a personal liability umbrella policy, you have to increase these underlying coverages on your auto policy, typically 250, 500, and 100. So the insurance company requires you to beef up your auto insurance policy before you put the umbrella on. It's their way of making sure they get paid. But the umbrella policy itself is pretty inexpensive. If you're an attorney, if you're a doctor, if you're a high earner, if you're a business owner and you have a lot of assets, it's a no-brainer. And so as a financial planner, I make that recommendation all the time. For you, I just want you to know what you have and how it works. So when you get your quote this week, you're going to know what that means, what those numbers mean. Let's jump into collision coverage. There's a lot more here, but I want you to know the difference between collision and another coverage called comprehensive. So we'll start with collision. What is the definition of collision? What do you think it means? The coverage on your auto policy provides coverage for collision. What do you think that means? What is the collision coverage cover? What's the definition of collision? What would make your policy respond if you actually had a collision? What would be the collision? What's a collision? Got anybody? Car hits something. That's pretty good. Accident, pretty general. That's not really going to get you there. Tuyen? Tron? Yes, accident's too general. Car hits something, that's pretty close. So car hits what, Harrison? Car hits something. Car hits tree. Car hits a cow. Car hits another car. Car hits a telephone pole. Car hits a building. All of those would be collision. So yeah, it would have to be an accident, but an accident is way too general. So there's a lot of ways you can have an accident that would not be collision. So this does say what Part D collision covers. It protects against an accident involving another car running off the road into a creek or lake, tree, wall, so many other things that a collision could be. And that word accident is important. but it's not specific enough to get us to the collision part, but it's a prerequisite, okay? Everything in insurance has to be an accident before the insurance policy pays. If it's intentional, we got a problem. Then we talk about exclusions because intentional acts are almost always excluded. So it has to be an accident, but just because it's an accident doesn't make it collision. So let's talk about some other things that will help put that into clarity for you. So the next coverage I want to talk about is comprehensive. Before I talk about comprehensive, I'm going to talk about perils. Perils are important to understand whether you're talking about a car or your home. And if you're talking about comprehensive, there's a list of perils that are included in comprehensive. So they're there to say very specifically, if this happens to your car, it is going to be covered under comprehensive. So what does the word comprehensive mean? It's in your notes, by the way. I could scroll down and find it. I'm scrolling down through a list of perils, whole bunch of perils. And then I'm looking at, so we're going to get into that. Somewhere in here we have the definition of comprehensive. I thought I had it at the top, but I don't. Anybody know what the definition of comprehensive is? Come on. You can put it in your comments if you're watching on the YouTube. So comprehensive means pretty much everything. It's very broad, and that's what comprehensive covers. But there's an exclusion. We've talked a little bit about exclusions. An exclusion is something that's specifically listed in the policy that says this is not covered. So when you look at your coverages, you're always going to have a list of exclusions. And in your comprehensive coverage, even though the word means everything, they still go ahead and they list perils for you so that you can see what specific perils are covered. And these are perils that are covered under comprehensive. Earthquake, explosion, windstorm. Somewhere we have flood, we have hail, water, flood, mischief, vandalism, riot. Did you know that if your car was damaged in a riot, that's a peril that's covered under comprehensive? Contact with a bird or animal. So before we said collision included colliding with, I said cow, and I was wrong. That's not right. So if you hit a cow or a deer or a bear, it's not collision. It's comprehensive. My very first claim when I was a State Farm agent, for the very first day, the very first hour, my very first claim, I was in Pennsylvania in Ridgeway, Allegheny National Forest. The phone rang very early in the morning, and one of my clients had totaled their car by hitting an animal in the woods. Do you know what kind of animal it was that they hit in the woods of Pennsylvania in the Allegheny National Forest? It wasn't a cow. It wasn't a deer. It wasn't an elk, even though we lived in Elk County. And believe me, if you hit an elk in Elk County, which you could do because there was a whole herd of elk in Elk County, which is why they called it Elk County. In fact, Ridgeway was the county seat of Elk County, which is weird that they had elk there. They brought the elk in. They're big animals. If you hit one, it's going to ruin your car. But it wasn't a deer. It wasn't a cow. It wasn't an elk. Anybody know? Not a moose. Jose, yes. Did you know that, Jose? It's a bear. It was a bear. My client hit a bear and totaled their car. So they filed a claim. Their claim was covered under comprehensive, not collision. Okay, that's important to know for reasons that may not make sense to you right now. But when you call me in 3 years and you say you hit a bear or a deer or a cow, and you're going to be like, what do I do? What kind of claim should I file? Call me and I'll give you some good advice, because it's important what coverage you file. If you file a comp claim, it doesn't count against you. So if you file a collision claim it's your fault, that's going to count against you. But if you file a comp claim, that doesn't count against you. Your insurance rate won't go up. So you're better off hitting a bear than a car. Because if you hit a car, that's collision. If you hit a bear, that's comp. Okay? So that's important to know. Um, that contact with a bird or animal, either one, is comp. So those are all the things listed under comp. But there's an interesting thing I want to share before we end up today. Man, we're out of time, aren't we? Well, I'm going to have to end it there. Maybe I'll tell this story in the next class and you can watch the beginning of the next class. Uh, Comprehensive means everything. So it's one of the coverages, depending on your insurance company, that will cover anything that happens to your car unless it's excluded. And the number one exclusion for comprehensive, don't miss this. This is really important. The number one exclusion for comprehensive, this will be on the test, is collision. Collision is not covered under comprehensive. That's a whole nother coverage called collision. So just know that even if comprehensive covers everything, because it's so broad, one of the exclusions is collision. You have to have collision coverage to get covered for collision, just to make it a little more confusing. I hope that helps. You guys, I will see you next week. Next week, we're going to get into investing. I might finish up with insurance for a few minutes next week, but this week, your assignment is to get an auto insurance quote. Take a look at the notes that I posted in Money Study Group. It'll help you understand the coverages and especially your auto policy. When you get that quote, you'll learn a ton about the coverages that are involved in your auto policy. I look forward to seeing your assignments in Blackboard. Have a great week. I'll hang around if you got any questions. Uh, sure. Yeah, no, you do not need to include your attendance. I think I was asking for that at one time, but not now. I'm assuming you got full points for all of your assignments. Is that true? So you did not get any deductions. What I'm looking for in each assignment, though, is class participation, not so much attendance, but if you watch on Zoom or you watch on Facebook or YouTube later, which you're required to do, you're required to attend class either watching it on YouTube, Facebook, or in the Zoom meeting. And in the assignments, I generally have like something I ask you to post. And that's what I'm looking for in your assignment is whatever that is, whatever question of the week I ask you to briefly comment on, uh, either on YouTube, Facebook, or in Money Study Group. That is the screenshot you need to include. Does that make sense? Yep, it sure is. That's what it's there for. Yep. So anytime you make a comment in one of those discussions, just grab a screenshot. You don't have to comment on everything throughout the whole week, but just show me that you're participating and that you're commenting, and that's what that's there for. Thank you. Good question. You too. Bye bye. Any other questions? Yes. Yeah. If you don't, that's what I would do. So if you already have insurance, if you're on your parent, are you on your parents' policy? So I would just call up your agent, whoever the company is, tell them you're thinking about buying this car and you want to get a quote. That'd be awesome. And you might get a surprise. I think we got, I think the quiz is in Quizlet, so I'll be opening that up. I, yeah, I think it's there. Do you see it? Yeah, you, yeah, yeah. Play around with that and just grab a screenshot when you get through it. I think you get multiple options for how you do that Quizlet, but students tell me they like Quizlet, so I tried to include that this week. All right. Okay, I'm going to wrap this one up. I got to get ready for my next one, unless there's another question. Okay, I'm going to finish it up.